Welcome to the deep dive. Today, we're pulling back the curtain on a corner of the financial world that often feels a bit mysterious, maybe even a little intimidating.
Yeah.
Systematic investing. Quant trading.
Yeah, it gets called a black box for a reason, doesn't it? It can seem opaque, super technical. But what we're going to explore today, using Rishi K. Narang's third edition of Inside the Black Box, is that, well, while the systems are complex, the ideas behind them, often surprisingly grounded, things that make intuitive sense.
Exactly. So our mission with this deep dive is to take that black box, peek inside, show you the core components, maybe some surprising insights, and bust a few myths along the way.
Yeah, sort of a shortcut to understanding what makes these quant systems tick.
Right, what challenges they face, how they fit into the bigger market picture. Think of it as us opening up the box together. Let's unpack this.
Okay, so where do we even start? What is systematic investing, really, at its heart? Narang makes this really crucial distinction early on.
Which is,
It's not necessarily the ideas themselves that are different from, say, traditional investing. It's the how, the method of putting those ideas into action.
that's interesting. So the goal might still be, buy low, sell high, or follow the trend. But the difference is how you decide when and how much to trade.
Precisely. Instead of a human manager making subjective calls, maybe relying on gut feeling, systematic investing uses a rigorous, often automated system. But the core ideas, they're often based on economic logic. Most people get like value or momentum, mean reversion, stuff like that.
Okay, so ideas aren't magic, but the system is the key thing. And diversification is huge for these systems, isn't it?
Oh, absolutely. It's not about hitting home runs. It's about making lots of small bets across different stocks, different markets, different times, or all of the above.
Why? Because even the best quant signals aren't that accurate on any single trade.
Exactly. The book really hammers this home. Even successful strategies might only have a slightly better than, say, 50-50 chance of being right on one specific forecast.
That feels weird.
Yeah.
With all that math, you'd think they'd be right way more often. So success comes from just consistency over tons of trades.
Yes. It's that small probabilistic edge applied again and again and again. And crucially, while the trading might be automated, most of the heavy lifting, the brain power, that's human-led scientific research.
So it's not just computers running wild. Humans are still very much in the loop.
Critically involved. Humans design the systems, they research and test the strategy ideas, they pick which things to trade, the speed, and importantly, they usually hold the panic button.
The override switch for when things go really haywire.
Exactly. If markets do something completely nuts that the model just wasn't built for. So the black box isn't some scary AI overlords, it's more a metaphor for this structured discipline system that executes human research.
Got it. And the book, Narang's book, it actually diagrams the main modules inside this system, right? Exhibit 2.3.
It does, yeah. It's super helpful for visualizing it.
Okay, let's open it up then. What are the main pieces working together inside this box?
Right. So at the core, you've got the alpha model. Think of this as the engine trying to generate returns. It makes the predictions.
Like which way a stock price might go.
Yeah, or a future, or whatever you're trading. If you're doing trend following, the alpha model is forecasting. Is this trend likely to continue?
Okay, that's where the actual trading signal originates.
Yep. Then, super important, you have the risk model. Its job is basically to map out and manage the risks the portfolio is taking.
So you know what bets you're actually making, not just stumbling into, say, a huge bet on the energy sector because your value stocks happen to be oil companies.
Exactly. It separates the intentional bets, the alpha you're chasing, from the incidental exposures. Because any strategy takes risk, right?
For sure. The book mentions even Warren Buffett's value strategy got hammered during the dot-com bubble. You have to manage the environment.
You do. The risk model is key for that. Then the third piece is the transaction cost model.
The friction.
Yeah, the friction. For quants trading a lot, these cost commissions, slippage, market impact can be a killer if you don't account for them. This model tries to quantify how much it'll likely cost to make a trade.
Right. You need to know if the potential profit is even worth the cost of getting in and out.
Absolutely essential. So these three models, alpha for predicting returns, risk for managing downside, and transaction costs for the friction, they all feed into the portfolio construction model.
The brain of the operation.
Kind of, yeah. It takes all that input and tries to figure out the best portfolio. It's balancing chasing profits, limiting risk, and minding those trading costs.
Sounds like a serious balancing act.
It is.
Yeah.
And once it decides on that target portfolio, it sends the instructions to the execution model.
Which actually places the trades in the market.
Exactly. And the whole thing, the whole system is fueled by data and constantly being tweaked and improved by human research.
That's the black box, demystified. A disciplined system for executing tested ideas, trying to take emotion out of it.
That's the goal.
Okay, let's dive a bit deeper into those alpha models. That's where the core money-making ideas live. The book says there aren't actually that many fundamental ideas, but just tons of ways to implement them.
That's a really great insight. Think about correlation. That's the idea. But you could measure it using Pearson's Rho or Kendall's Tau or Spearman's rank.
Yep.
Lots of different implementations of the same core concept.
I agree.
And most systematic strategies are theory-driven. They're based on some economic or market logic. Purely data-driven strategies exist, but they tend to be more complex, maybe less common.
And these theory-driven ideas generally use either price data or fundamental data.
Broadly speaking, yes. On the price side, the two big ones are trend following and mean reversion. Trend following is pretty intuitive. Bet that prices moving one way will keep going that way.
Like momentum.
Yeah, basically momentum. Richard Donchian's old future system is a classic example, super simple. Buy if the price breaks the 2-week high, sell short if it breaks the 2-week low.
Just riding the wave.
At its core, yes. Modern versions are way more complex, obviously, but it's a fundamental market behavior. People chase trends. But here's a surprising thing the book points out about trend following.
What's that?
Successful trend followers historically tend to earn less than $1 of profit for every dollar of downside risk they take on.
Wait, less than 1-to-1? On average, that sounds tough.
Right.
Why do it then?
Well, it doesn't sound great in isolation, does it? And their returns are really streaky. You get these long, painful periods where trends just don't work. They chop around, and you lose money. You have to be ready for big drawdowns.
So the payoff must come from
Capturing those really big, sustained moves when they do happen, those huge trends can make up for all the small losses, but you need deep pockets and strong nerves to stick with it through the bad times.
That's a really critical point for anyone thinking about this stuff.
Yeah.
Okay, what about the opposite? Mean reversion.
Right. Mean reversion bets that prices will snap back towards some kind of average or equilibrium. The idea is prices don't just wander off forever. They fluctuate around a center of gravity.
What might cause that?
Could be short-term imbalances, like a stock gets added to an index, everyone has to buy it, maybe the price overshoots temporarily and then it settles back down, or just market overreaction to news.
So trend following bets on continuation, mean reversion bets on reversal. Can they both actually work?
Yeah, they often do, just in different market conditions or over different time horizons. Trend might work great when markets are strongly directional, like, say, 2008. Mean reversion might do better in calmer, range-bound markets.
Exhibit 3.5 in the book shows that kind of dynamic, right?
Exactly. One zigs when the other zags sometimes. So combining them can smooth things out.
Interesting how opposing ideas can both have value.
Oh.
Okay, shifting gears.
Yeah.
What about fundamental-based strategies?
These use things like company earnings, balance sheets, economic data. Value yield is a classic. Think FAMA in French, finding assets that look cheap based on metrics like book-to-price ratio or earnings yield.
And how do quants usually play that? Just buy the cheap stuff.
Often it's done as quant long-short, or QLS. They don't just buy cheap stocks in isolation. They'll rank a whole universe of stocks, say, all the tech companies, based on a value metric. Then they buy the highest-ranked, cheapest ones, and sell short the lowest-ranked, most expensive ones.
Ah, so it's about relative value within a group. Betting the cheap ones will outperform the expensive ones.
Precisely. Other fundamental types include growth sentiment, betting on companies with strong growth, maybe even if they look expensive on traditional metrics, also supply-demand factors or quality metrics like stable earnings or low debt.
And then there are tactical event strategies. Those sound different.
They are. They try to capitalize on specific, often one-off events where history isn't much of a guide. Think Brexit or maybe a major policy change.
Hard to backtest those, I bet.
Very hard. You don't have hundreds of Brexits to test on. But they offer potential profits that might be totally uncorrelated with your other strategies if your team can make the right call on how the market will react.
So you've got all these different alpha signals potentially firing off forecasts. Do quant shops just pick their favorite one?
Almost never. Lending multiple alpha signals, especially ones that aren't perfectly correlated, is really key. It improves the consistency, the robustness.
Makes sense.
The book makes a strong point that basically any reasonably smart way of combining different forecasts is likely to do better over time than just relying on one single signal. Exhibit 3.9 shows this.
How do they combine them? Just average the signals.
Sometimes it's simple linear models, basically averaging or weighting them. Other times they might build entirely separate portfolios for each alpha strategy and then combine those portfolios.
Like building a team with different specialists.
Exactly like that.
Okay, alpha generates the ideas, but the risk model is what keeps you from blowing up.
Pretty much. Its main job is identifying, measuring, and then helping manage all the systematic risks you're exposed to. It helps make sure your bets are intentional.
Like, are you taking interest rate risk because you want to, or just because your value stocks happen to be sensitive to rates?
Exactly. The risk model makes that explicit.
And does it control the overall level of risk, like how much leverage the fund is using?
It can, yeah. A common tool here is value at risk, or VAR. It tries to forecast your potential loss over a certain period based on past volatility. If markets get choppier, volatility goes up.
The VAR model might say, okay, dial back the leverage
Right.
to keep the potential dollar loss capped.
Right. Keep the level of risk somewhat stable, even if market conditions change.
What are the challenges in building these risk models, especially relying on historical data?
Oh, big challenge. It's this constant trade-off. You need enough history to get statistically meaningful results, right? But if you look back too far, say 10 years, your model might be too slow to adapt when the market regime actually shifts.
Because the recent past might be more relevant than stuff from a decade ago.
Often, yes. But if you only look back, say, 1 year, your model is adaptive. But maybe it's just reacting to noise, not real changes. You're always balancing data quantity versus data relevance. Tricky.
So even with all the quantitative tools showing you the risks, there's still a judgment call.
Absolutely. The tools give you the information, make the risks transparent, but the portfolio managers still have to decide how much risk is acceptable, how to react to the model's output. Judgment is still crucial.
Okay, alpha predicts, risk controls. Transaction cost models deal with the unavoidable friction of actually trading. Why is this so vital for quants?
Because they often trade a lot, maybe in sizes that are large relative to the available liquidity, even tiny cost per share can completely erode the profitability of an alpha signal if you don't account for them properly.
So the model asks, is the predicted alpha big enough to overcome the cost of trading?
Exactly. Is the juice worth the squeeze?
What are the main cost components?
Well, you've got the obvious ones, commissions and fees, paid to brokers, exchanges, regulators. For big quants, the per-share cost is usually tiny, but multiplied by billions of shares, and it's still significant revenue for the brokers.
And then the less obvious implicit costs.
Right. Slippage. That's the difference between the price you thought you'd get when you sent the order and the price you actually got filled at. Volatility makes this worse.
And the big one, market impact.
Yeah.
Your own trade moving the price against you.
Yes. If you need to buy a lot of stock quickly, your buying pushes the price up before you're finished buying. Selling pushes it down. The size of your order relative to liquidity is key here, and the book highlights its quadratic nature, meaning that cost per share often goes up disproportionately as your order size increases. Doubling your order size might more than double your impact cost per share.
Ah, that Pulled Homes example the book uses later really drives that home. A huge liquidation order caused a massive price swing.
Exactly. Trying to dump a huge position quickly, like LTCM had to do in '98, can be incredibly costly due to market impact. So quants build models, simple linear ones, or more complex quadratic ones to estimate these costs before they trade. It helps them decide how big a position to take and how quickly or slowly to trade it.
Okay, makes sense. So alpha, risk, and cost all feed into the portfolio construction model. This is where it all comes together to decide the final portfolio mix.
And this step is absolutely critical. You can have the best ideas, the best risk management, perfect cost estimates. But if you mess up the portfolio construction, if you allocate capital poorly, you can completely negate all that other good work.
How do they actually build that portfolio? What are the methods?
There are rule-based approaches. Could be as simple as equal weighting every position.
What's the benefit of that?
Yeah.
Seems almost too simple.
Well, one benefit is robustness against bad data. The book gives that example of a UK stock price error listed in pence instead of pounds, off by 100x. If you're equal weighting, that bad data point leads to one small wrong position. If you're weighting by, say, forecast strength, it might lead to a disastrously large position.
Ah, okay. So equal weighting provides some safety against outlier errors. What about alpha weighting? Putting more money on the strongest signals.
Right, that's trying to maximize your conviction, put your capital where your forecasts are strongest. But the book notes strategies that do this heavily, like maybe some friend followers, can have really sharp drawdowns.
Why?
Because you often build up your biggest positions after a trend has already run a long way. You have the strongest signal then. But that's also when the trend is most vulnerable to suddenly reversing, catching you with your largest position size.
Ouch. Okay, so rule-based methods. What's the alternative?
The other main approach is using optimizers. These are mathematical algorithms trying to find the portfolio that gives you the best bang for your buck, risk-wise. Like maximizing your expected return for a given level of risk, or maximizing your Sharpe A ratio.
Conceptually simple. Find the best mix.
Conceptually, yes. But in practice, they involve complex calculations with lots of interacting variables, expected returns, volatilities, correlations between potentially thousands of assets. So they can feel a bit like a black box themselves, even to the people using them.
And the book warns they're super sensitive to the inputs.
Extremely sensitive. Tiny errors in estimating future alpha or future volatility, or especially future correlations between assets, can lead the optimizer to suggest wildly different optimal portfolios.
And predicting correlations is notoriously hard, right? The S&P 500 versus Nikkei example.
Exhibit 6.4, yeah.
Yeah.
It shows how unstable historical correlations can be. They jump all over the place. Feeding reliable future estimates into an optimizer is a massive challenge.
So things like resampled efficiency are attempts to make optimizers less sensitive to those input errors.
Correct. Trying to make the output more robust. But despite the complexity, the general outcome of using optimizers is usually aligned with the basic idea. You end up putting larger positions on the assets where your alpha model has the strongest conviction.
Okay, portfolio constructed. Now, execution. Getting those trades done in the real market, where the rubber hits the road.
That's it. Translating the plan into reality. And firms face a big choice here. Build or buy. Do you invest millions in building your own sophisticated execution systems and hiring the expertise?
Which gives you more control, potentially lower cost long-term, but is a huge upfront investment.
Right. Or do you buy execution services from brokers or specialized vendors? You pay them, often through slightly higher commissions, but you leverage their existing infrastructure and expertise.
And once you're trading, you have to decide, how aggressive do you want to be?
Exactly. Do you use aggressive orders? Like market orders or limit orders that immediately cross the bid-ask spread? These give you high certainty of getting filled quickly.
But potentially at a worse price.
Potentially, yes. The alternative is passive orders. Placing limit orders at the best bid if buying, or best offer if selling, or maybe even inside the spread, hoping the market comes to you.
Better price if you get filled, but no guarantee you will get filled.
Right. And passive orders face that big risk. Adverse selection.
Explain that again.
Okay, imagine you have a passive buy order sitting at the best bid price. You're waiting for a seller. If the market suddenly starts moving up because someone else, maybe someone with better info, starts aggressively buying above your price.
Your passive order might get filled only by sellers who are desperate to get out just before the price jumps higher. You're getting the shares nobody else wants at that price anymore.
That's the risk you get selected against. Your order only executes when the price is already moving against you. Conversely, someone aggressively crossing the spread might be signaling they have information that justifies paying that extra cost.
Which is why speed becomes so incredibly important, especially for high-speed trading, HST, and high-frequency trading, HFT.
Absolutely critical. The book goes deep into latency, the unavoidable delays, physical distance between you and the exchange, the speed of light through fiber optic cables.
Network congestion, those data bursts the book mentions.
Exhibit 14.11, yeah, showing how message rates aren't constant, the time it takes your own systems to process signals, and even delays built into the market structure itself, like Reg NMS consolidation.
What's that Reg NMS delay again?
It's a U.S. rule meant to ensure best price across exchanges. But the way the official consolidated data feed, the NBBO, is constructed means that firms connected directly to exchanges can often see price changes milliseconds before they show up on that slower consolidated feed.
Giving them a tiny head start?
A tiny but potentially crucial head start. Enough time to react, maybe place a trade, or, critically for passive orders, cancel their order before the rest of the market sees the price move against them.
So speed isn't just about getting your order in first. It's also about being able to cancel fast enough to avoid that adverse selection.
Precisely. Exhibit 14.9 illustrates that perfectly. If the market moves against your passive order, you need lightning speed to pull it before it gets filled disadvantageously. This speed is life or death for HFT strategies like index arbitrage.
Treating SPY against its component stocks.
Right. Or market making, providing bids and offers.
Market makers need speed, too. I thought they just sat there providing liquidity.
They provide liquidity, but they need speed to manage their risk. Contractual market makers, who get order flow routed to them, need to hedge or offload inventory quickly if they end up taking the wrong side of a move. And non-contractual ones, trading directly on exchanges against other pros. They face intense adverse selection pressure and need extreme speed just to survive.
Wow. Okay, so this whole incredibly complex machine runs on data. And the book is emphatic. Garbage in, garbage out. Bad data equals bad results.
The Mars Climate Orbiter example is just brutal, isn't it? Crashing because of a simple pounds versus metric units mix-up.
Yeah.
It highlights how critical data quality is.
And the top quant firms invest massively in this. Collecting raw data, cleaning it, storing it, making sure it's fast and accurate.
Huge investment. Dozens, sometimes hundreds of people just focused on data. Because it's the fuel. You have high-frequency price data for faster strategies, lower frequency, fundamental data like earnings, economic reports for slower ones.
What are the typical data headaches quants face?
Oh man, where to start? Wrong values, obviously. Incorrect values, like that decimal error example. A stock priced in pence showing up as 100 times cheaper because the system expected pounds. Easy mistake for a system processing millions of data points to make if cleaning isn't perfect.
And that could lead to bogus backtest results. A type ire.
Exactly. Thinking you have a winning strategy when it was just trading on bad data. Bad timestamps, especially for intraday data, are a nightmare. They mess up the sequence of events.
Asynchronicity, too. Markets closing at different times globally.
Yeah, news hits Europe, but the U.S. market is closed. The impact doesn't show up in U.S. prices until the next day. Creates lags, complicates analysis. Even just matching security identifiers across different data vendors is a huge, tedious task, the security master problem.
But the really sneaky one, especially in research, is look-ahead bias.
Ah, yes. The cardinal sin of backtesting.
What is it again exactly?
It's using information in your simulated historical test that you wouldn't have actually known at the moment you were simulating the trade. The classic example is using the day's closing price to generate a signal for a trade supposedly made during that same day.
Because in the simulation, the future closing price,
Yeah.
but in reality, you wouldn't have.
Right. It makes your backtest look potentially amazing, but completely unrealistic. It's like betting on a horse race after you already know who won.
So how do researchers fight look-ahead bias?
Rigorous timestamping, knowing exactly when each piece of data actually became available historically, building in artificial delays in simulations. Some firms separate the research teams from the portfolio management teams to provide another layer of scrutiny. It's not an issue in live trading. Of course, then you want data ASAP.
Okay, so clean, timely data feeds into the engine of innovation, research.
This is where the ideas come from, ideally following the scientific method. Develop a theory, test it with data. Ideas pop up from watching markets, reading academic papers, people migrating from physics or math, even observing what successful discretionary traders do and trying to systematize it.
How do you know if a potential strategy idea is actually any good? What do you measure?
Several things. First, worry about sample bias. Is your historical test period actually representative? The convertible bond ARB example is great, looked amazing from 1997, then blew up in the 98 crisis. A long backtest isn't foolproof if the underlying market regime changes, requires judgment.
You look at predictive power, right? Like R squared. How well does this signal actually predict future moves?
Yes, and here's another reality check for many people. Financial R-squared values are tiny compared to, say, physics. The book mentions an out-of-sample R-squared of 0.05 being considered superb.
5%? That seems incredibly low.
It is. There's even a quote about people getting rich off an R-squared of 0.02.
How is that even possible? It sounds like noise.
On any single trade, it's close to noise. But remember the diversification point. If you have that tiny, tiny edge, that 0.02 predictive power, and you apply it thousands, maybe millions of times across different trades.
The law of large numbers kicks in. That tiny edge aggregates into real profit over time.
That's the logic. It's not about being right often. It's about having a persistent, small advantage applied consistently at scale.
Okay, that reframes things. What else do you look at?
Consistency. What percentage of trades or periods, days, weeks, are winners? Higher is generally better, smoother returns. The S&P strategy example wins about 54% of the time. It signals barely better than a coin flip, but enough.
And risk-adjusted returns, like the Sharpe ratio. Return per unit of risk.
Yep, higher is better. A Sharpe of 2 is often seen as very good in the hedge fund world. You also have to check sensitivity to parameters.
Meaning?
If you change your rule in your strategy just slightly, like use a PE ratio cutoff of 11 instead of 10, and the results change drastically, that's a bad sign. It probably means your original result was just luck, or you perfectly curve fit the historical data. You
Hmm.
want smoothness. Small parameter changes should lead to small performance changes.
And related to that is parsimony, Occam's razor. Keep it simple.
Generally, yes. A simpler theory is easier to test, less likely to be overfitted. But it's a balance. Too simple is underfitting your model misses the real pattern. Too complex, and you risk overfitting.
Overfitting. The book calls that the worst sin in quant finance.
It really is. It means you've built a model that matches your historical data too perfectly. It's fitting the noise, the random fluctuations, the historical accidents, rather than the true underlying repeatable pattern.
Like drawing a wiggly line that hits every single point on a noisy chart.
Exactly. It looks brilliant on the data you used to build it, but it falls apart completely when you show it new data because it learned the wrong lessons. The height math aptitude example is perfect fitting height when age was the real driver.
So avoiding overfitting is job number one in research.
Absolutely critical. But the challenge today, the book argues, isn't just avoiding overfitting, a type I error, seeing a pattern that isn't real. It's also avoiding underfitting, a type 2 error, missing a real pattern because your model is too simplistic. Finding that optimal balance is the real skill, especially as markets get more efficient and the easy, low-hanging fruit strategies get crowded.
And that balance might depend on how strong your prior belief is versus how much data you have.
Right, like the COVID example. Strong prior belief, travel stocks will get crushed, might justify acting even with limited direct historical pandemic data, carefully managing the overfitting risk based more on theory than just data fitting.
Okay, so putting it all together, quant trading is this complex, structured process, but it gets a lot of criticism. Let's tackle some of those risks and criticisms.
Sure, a common one you hear. Trading is an art, not a science. Markets are human, emotional, unpredictable. You can't model that.
But the counter-argument is, quant methods are used to model human behavior elsewhere, right?
Yeah.
Like Amazon recommendations or HR analytics. And automation brings consistency, removes biases like fear and greed, which can be powerful, plus humans are still involved.
Right, they build it, they oversee it, they hit the panic button. Another big criticism, quants cause volatility or underestimate risk. They get blamed for flash crashes or recently maybe exacerbating oil price swings.
But volatility existed long before quants, didn't it? The 1987 crash, tulip mania. And the 2008 crisis, the really big one, wasn't primarily caused by quant hedge funds,
Right.
but by leverage, bad lending, maybe flawed models and structured products at banks.
Exactly. And the data the book cites on intraday volatility, exhibits 8.2, 8.3, 8.4, suggests it hasn't really increased overall since HFT became dominant, maybe even contracted slightly. The argument is HFTs generally provide liquidity, and it's illiquidity that fuels volatility.
Okay, what about quants cannot handle unusual events or regime changes. Their models break because the past is no longer a guide.
That's a fair challenge.
Yeah.
Models trained on history can struggle when fundamental relationships change. Value versus growth leadership shifts. Big events like the Bear Stearns bailout altering market structure. But some quant strategies like counter-trend or breakout systems might actually thrive in that kind of volatility. And again, the human oversight is there as a backstop. It's not like all trading strategies, discretionary included, sail smoothly through regime changes.
True. What about the idea that quants are all the same?
Just false.
Yeah.
Huge diversity. Different ideas, different data, different time frames from milliseconds to months, different risk tolerances. It's a very varied landscape.
And the criticism that only a few large quants can thrive due to resource advantages.
Resources definitely help data, tech, talent. But smaller, nimbler firms can succeed by focusing on specialized niches that might be too small for the giants. And the giants face their own challenge. Deploying huge amounts of capital forces them to diversify, sometimes into weaker or more crowded strategies, which can dilute returns or increase risk. Think LTCM or Amaranth. Experience and having a real edge seem more important than just size.
Okay, last one. Are quants guilty of data mining? Just finding random patterns with no economic basis.
Well, pure data mining without theory is risky, prone to finding spurious correlations. But data mining techniques are used legitimately in many sciences, like genomics, to find potentially useful leads. Most reputable quants start with an economic rationale and use data mining carefully, with rigorous testing out of sample checks, sensitivity analysis specifically to avoid overfitting. The skill isn't avoiding data, it's managing the overfitting-underfitting trade-off intelligently.
So it's about scientific rigor and exploring data, not just blindly finding patterns.
Exactly. It's science and engineering applied to markets, with human judgment layered on top.
All right. So if you're an investor looking at this space, how do you evaluate a quant manager or strategy?
The book boils it down to two key things. First, really understand the strategy. What's the core idea? Where does the return come from? What are the risks? When would you expect it to do poorly? Second, judge the people. What is their edge?
Evaluating the people. What signals good versus bad?
Look for well-trained teams, people with actual experience trading live markets, not just academics who've only ever backtested. Are they realistic, cautious, humble? Do they understand the challenges, data issues, competition, overfitting? You dig into their process, the quality of their research, how they handle data. Exhibit 12.2 has a useful mind map for that kind of due diligence.
And finding that edge. Why this particular team is likely to keep making money when others might not.
Yeah, what makes them different? Is it unique data? Better technology, a genuinely novel research insight, superior execution. That's what you're trying to identify. Because done well, quant can offer attractive risk-adjusted returns and diversification.
We also touched on the high-frequency trading, HFT, controversies from the appendix. Big one. Is HFT unfair? Does it create a two-tiered market?
That's the accusation the super fast have an unfair leg up. The book's counterpoint is, well, yes, they have an advantage based on speed and technology investment, but is that inherently unfair in a competitive market?
Like any business investing in better tools or faster processes?
Kinda, yeah. Like Warren Buffett having advantages due to his capital and reputation, or a Formula One team spending fortunes on engineering. HFT firms compete intensely on speed to capture tiny edges, like getting orders in or out microseconds faster. Is that competition or unfairness? The book leans towards competition.
What about manipulation, front-running, things like, quote, stuffing?
The book argues there's actually very little credible evidence of systemic manipulation or front-running by HFT firms, although obviously illegal activity can happen anywhere. Manipulation is illegal regardless of your trading speed. Quote, stuffing might look suspicious, but in today's fragmented markets with dozens of exchanges, it can actually be a rational risk management technique, posting orders widely and canceling the unneeded ones instantly once you get a fill somewhere.
And that Goldman Sachs case people bring up.
That was about code theft and employees stealing proprietary algorithms, not about HFT itself being inherently manipulative.
And we already discussed that HFTs are generally liquidity providers, which is crucial for market function, and the data doesn't really support them, causing more volatility overall.
Right. The book's view is HFT firms are mostly specialists, playing by the rules in a very specific high-speed game of arbitrage and liquidity provision. Regulators need to keep up with technology, improve data feeds, maybe rethink exchange rebate structures, but banning HFT because of isolated incidents or misconceptions would likely harm markets more than help.
Wow. Okay, that was definitely a deep dive. We've really gone inside that black box. We've seen it's not magic, but a structured system. Alpha, risk, costs, portfolio construction, execution, all running on data driven by human research.
Yeah, and we've uncovered some maybe counterintuitive things, like the fact that tiny predictive edges can be profitable at scale, the real difficulties of strategies like trend following, the absolute nightmare of bad data or overfitting, and we've tackled some of the common criticisms, trying to separate hype from reality.
It really comes across that systematic investing, when done right, is a sophisticated blend. It's science, it's engineering, but there's still this critical layer of human judgment involved in building it, running it, and knowing when to step in. It's about discipline, intentional risk-taking.
And the ultimate challenge isn't just coding complex algorithms, it's the human skills. Generating truly novel ideas, designing rigorous tests that avoid bias, being meticulous with data, and constantly navigating that tricky balance between exploiting past patterns and adapting to a future that might look very different.
So, after peeling back all those layers, what stands out most to you about this world? Anything particularly surprising?
And maybe a final thought for you, the listener, to chew on. These quant systems are incredibly powerful at finding patterns in historical data, but we seem to live in a world with increasingly frequent, truly unprecedented global events, things with no real historical parallel. So how will these systems, designed based on the past, continue to adapt and thrive in that kind of future?